You're sitting in your home office on December 28th, staring at an invoice you could send today or a bonus check your client offered to cut before year-end. Why do some people deliberately tell their clients, "Actually, can you pay me in January instead?" even when they desperately need the money right now? Today, I'll explain the delay income until January tax strategy like you're 5 years old. By the end, you'll understand exactly who this helps, when it backfires completely, and why the IRS actually allows people to push money into the next year on purpose. Here's the basic idea. Every dollar you earn gets taxed based on when you receive it, not when you do the work. If a client pays you on December 31st, that money counts as this year's income. If they pay you on January 2nd, it counts as next year's income. And here's why that matters. You file separate tax returns for each year. Pushing income into January means you're spreading your earnings across 2 tax years instead of stacking everything into one. For some people, that move drops them into a lower tax bracket for the current year and saves them real money. Let's talk tax brackets for a second, because this strategy only works if you understand how they function. The US uses a progressive tax system. Different chunks of your income get taxed at different rates. If you're single in 2024, the first $11,600 you earn gets taxed at 10%. The next chunk up to $47,150 gets taxed at 12%. The chunk after that gets taxed at 22%. And it keeps climbing from there. You don't pay one flat rate on everything. You pay different rates on different slices. This matters because if you're sitting right at the edge of a bracket, one extra dollar pushes part of your income into the next higher rate. Now imagine you're a freelance graphic designer. You made $46,000 this year. A client offers you a $3,000 project that'll pay in late December. If you take that check now, your total income hits $49,000. That extra $1,850 above $47,150 gets taxed at 22% instead of 12%. That's an extra $185 in federal taxes on that portion alone. But if you ask the client to pay you January 5th instead, your 2024 income stays at $46,000. All of it stays in the lower bracket. Next year, that $3,000 gets taxed starting fresh in the New Year's brackets. You just saved yourself about $185 in federal taxes by waiting 2 weeks. But here's where it gets tricky. This strategy only works if you actually control when you get paid. If you're a W-2 employee with a regular paycheck, you can't delay anything. Your employer decides when payroll runs. You can't call HR and say, "Hey, skip my December 30th check and add it to January." This trick is only available to freelancers, contractors, small business owners, and anyone who invoices clients directly. Even then, your client has to agree to wait. Some will, some won't. And here's the part most people miss. Delaying income doesn't always save you money. It only helps if next year you'll be in the same tax bracket or lower. If you're expecting a big raise, a new contract, or a major income jump next year, pushing money into January could actually cost you more. You'd be adding that delayed income on top of an already higher base, possibly shoving even more money into higher brackets. The math flips completely. Suddenly you're paying more tax overall just because you delayed. The strategy assumes next year looks similar to this year income-wise. Here's another wrinkle nobody talks about. There's another group who can't use this trick at all. Anyone at risk of the alternative minimum tax. The AMT is a parallel tax system designed to stop high earners from using too many deductions. If you're anywhere near AMT territory, income timing games can trigger it accidentally and wipe out any savings you thought you'd get. We're talking about single filers making over $85,000 or married couples above $133,000 in many cases. You'd need to run the numbers with tax software or an accountant before trying this move. Now check this out. The IRS actually allows this strategy completely legally under something called the cash method of accounting. Most individuals and small businesses use cash accounting, which means you report income when you actually receive it, not when you earn it. That's the entire reason this works. You're not hiding income. You're not lying. You're just controlling the calendar. The IRS knows people do this. They built the rules this way on purpose. As long as you report every dollar you receive in the correct year, you're fine. But there are limits you need to know about. You can't play games with constructive receipt. That's IRS language for you had access to the money, so it counts as received even if you didn't grab it yet. If your client mails a check on December 28th and it sits in your mailbox on December 30th, that's constructive receipt. It counts as 2024 income even if you don't open the envelope until January. If a client deposits money into your account on December 31st, It's 2024 income, even if you don't spend it for weeks. The key is whether the money was available to you before January 1st. Here's what you need to understand before you try this. This strategy works best for people who have 3 things at once: control over payment timing, income near the top of a bracket, and confidence that next year won't bring a big income spike. If you're missing any of those, the math falls apart. A freelancer making $180,000 this year, who's expecting $185,000 next year, gains almost nothing from delaying $5,000. Someone making $95,000 this year, who's about to take a $130,000 job next year, would be smarter taking every dollar now while they're still in a lower bracket. And here's the bigger misconception that drives me crazy. People think tax strategies like this are some secret wealthy people use to dodge payments. But this isn't a loophole, it's just timing. You're not avoiding tax, you're choosing which year to pay it in. The total tax you pay over your lifetime barely changes. You're just smoothing it out year to year instead of creating big spikes. The IRS gets their money either way. They just get it in a slightly different order. There's also state tax to consider, which complicates everything. Some states tax income the same year the IRS does. Others have their own rules. A few states have no income tax at all. If you live in Texas or Florida, this whole federal strategy matters more because you're only optimizing one tax system. If you live in California or New York, you need to check whether delaying income helps or hurts at the state level too. Sometimes the state brackets don't line up with federal brackets. You end up saving federally, but losing locally. California's top bracket kicks in at $61,214 for single filers, which is way lower than the federal 24% bracket starting at $100,525. Here's one more real-world consideration. Delaying income can affect more than just your tax bracket. It can impact your eligibility for certain tax credits and deductions that phase out at specific income levels. The Earned Income Tax Credit, education credits, and retirement contribution deductions all have income thresholds. If you're hovering near one of those cutoffs, pushing $5,000 into next year might save you way more than just the bracket difference. Or it might cost you if next year you're trying to qualify for something income dependent. So to recap, delaying income until January can lower your current year tax bill if you control payment timing, you're near the top of a bracket, and next year looks similar income-wise. It only works for freelancers and business owners, not W-2 employees. It backfires if next year brings higher income or if you trigger AMT. The IRS allows it under cash accounting rules as long as you avoid constructive receipt. It's not a loophole, it's just calendar timing, and it barely changes your lifetime tax total. State taxes can complicate the strategy depending on where you live. So here's the real question. If you can legally control when a client pays you and the math works in your favor, should you always try to game the calendar? Or is the mental energy and potentially awkward conversation not worth saving a couple $100?